debt, markets, and Sears. Oh my. What's up, everybody? Welcome aboard to Bubba's Bottom Line. Always great to be here with you on the weekends. And of course, well, I guess we should all shed a tear for Sears going into bankruptcy and done. And of course, they skinned it. They took everything out of it, and now it's going to be gone. And should we be concerned, or should we be concerned about Amazon? And the answer is, well, was not Sears the Amazon of its day? Okay, they just happened to run into a lot of mismanagement, and they tried to really do everything else, and my opinion, they did everything backwards and wrong. But hey, that's it. So long, Sears, an American icon, which we'll always remember the catalog and going back. But in the meantime, it's over. And of course, what do we have going on? Well, we had a pretty rocky week in the markets. And I think when you look at the big picture, it should be no surprise to anybody, which we've talked about this 4 weeks and months of what may happen. And of course, the middle class is once again getting screwed as we continue to see the rise of credit card debt. So we can talk about and listen to the pundits who tell us how great things are for everybody, and there's not any issues. But of course, credit card debt is soaring. Okay, margin debt is soaring. So we have many out there buying stocks with money they don't have to buy stocks they can't afford, that will end up puking them out as soon as we start to see. And I think you started to see some of that last week. You see when you see the late day sell-offs, that is usually margin. And just back in the day, before everything was computerized, we had things happen in the markets, and of course, you'd have to show your statement, so there was a little bit more margin. But typically, margin calls come in about 3 o'clock Eastern time, and so when you start to see some of that acceleration at the end, that is usually related to the margin calls. But we had this week we had our good old friend President Trump, who I have a lot of respect for and supported him, predicted him, and think he's doing a great job. But I do think he stepped over the deep edge here with his attack on Chair Powell and going into why rates should be lower. We think that rates should continue to rise. Now, I understand his point, but again, I believe that the central banking system in general, I believe that the whole picture, that the Fed and central banks should be abolished or at least audited. I don't like the fact that they have nothing to report to, but I don't think that Chair Powell, will succumb to the pressure. And I do believe that President Trump has made a little miscalculation, especially going into the midterms. I think that the markets are selling off a little bit, and I think that Chair Powell could actually, if he wanted to, because he is one of the most powerful men in the world, could actually hike rates a little bit faster if he wanted to, just to show the president who's the boss. Because again, he can be fired, but it has to be for cause, and I don't see the cause right now. But again, I think that was a slight miscalculation. And basically, you see the market selling off, you're trying to make sure that they don't sell off. And I think that that's unhealthy for the markets in general. I think the markets are going to sell off, and they should. Again, healthy markets go up and down. They just don't go straight up. You cannot continue to kick the can down the road. Eventually, it catch up to you. Okay, eventually you run into a wall, and there it is in full blow, all the mess that you have created. Does anybody realize the mess that's been created over the last 10 years with all this debt? Yes, the stock markets are higher, and it's great. I'm happy the stock markets are higher. Yes, our unemployment is much lower. Yes, we are seeing higher wages, but at what cost? Okay, look at what's going on with the debt. All right, margin debt, computer debt, credit card debt, auto debt, student loan debt. those are all things that are going to have to be paid back or forgiven. So we can continue to kick the can down the road and leave it for our children. And this is one of the problems. This is why we go into, there should be term limits, because all of these people that make these decisions don't really care. They don't want to step up and say that we've got to cut these costs. They just sent another spending bill in that is ridiculous. It's all it is piling on the debt. Now what's going to happen? Okay? What's going to happen is we, the middle class, will get it screwed. That's what's going to happen. Okay? Again, there's nothing new under the sun. All right? But there's a lot of signs and warnings that are continually out there that we continue to ignore. Okay? These patterns look very similar to 2000 to 2007 and even going back to 1987. And it's amazing that one of the people that I respect was on air last week and talking to some of the pundits about the charts and saying, well, this pattern looks a lot like 1929 to 1937. And he's right, okay? And because patterns do repeat, and they repeat over and over again, okay? They just repeat from different prices. But you get to a certain point where the market will take a bit of a sell-off. And again, we're not worried about the problem, okay? It should be part of the actual market. It's part of the workings of the market, okay? That's what we should be concerned about, not whether or not the markets go down. Markets cannot go up forever. We have a recession coming. Remember, the markets are forward thinking, all right? The yield curve is flattening as it's probably going to invert. All those signs point to an inflation, but of course, when you have to listen to the Federal Reserve, who doesn't understand anything until 10 years later because of their academic theory, okay, you will see that the problem is now they will turn around and blow it the other side. You know, just like markets, the Federal Reserve acts the same way, okay? They overreached in the beginning when everybody got away with the taper tantrum in 2013, when Ben Bernanke was still the Fed chair, those interest rates should have been going up from then. Okay, but no, the markets pushed them and forced them back down. Okay, now it's going to be the other way. Now we're going to go up too fast because of what do we have? We've got inflation showing up. Everybody wants to say, you listen to the CPI and the PPI, there's no inflation. Well, guess what? Everything you're paying for is costing you more, and it's only going to get more expensive. Now, what's going to happen is you've got wages that are going to start hiking, and good for the wages. I'm happy for the employees, but wages are going to start to go up, and they're not going up a little bit, okay? If you remember, not that long ago, the big talk was that we needed to get to $15 an hour minimum wage. Well, we're at almost $15. I know there's some McDonald's that are paying $14. There's some Walmarts now that are paying $12. And these are all 10 and 20 and 30 and 40% pay increases going forward. Okay. Now, again, that comes off the bottom line profit of the company. And you know who pays for those raises at the end, don't you? That's right. You and me pay for those raises because the companies aren't going to suffer. But then you mention the debt that they have, okay? They've borrowed money. They've borrowed a lot of cheap money. Well, who's going to pay for it when they have to pay more for their debt? You and me are going to pay for it. So the middle class is screwed, okay? Now, when you look at the bigger picture of everything, okay, we've got so much debt. You've got higher wages coming. You've got higher energy costs coming right now. Now, again, we're not a big fan, but right now that's what's going on. And you've got a dollar that's rising, which is causing a lot of problems throughout the globe and throughout the central banking system, which is going to create some sort of a panic. And again, this is one of the warnings that we've put out to you. It's no surprise that the market's selling off. I think it's going to get much deeper before it gets better. I think that you've got a very similar situation to what you've had in 2000, 2007, again, even 1987, but the 1987 collapse can never be recreated because of what we call the circuit breakers that are put in the market, okay? But at the end of the day, I think you have a lot of things that are indicating some issues that are starting to rise in the markets, and the patterns are looking alike, and you're starting to see that the markets are not acting as crazily to the upside. They're actually starting to work to the downside. In fact, I was on Fox Business at 4 a.m. on Friday morning when the market's up over 300, and I said, there's a good chance they're probably going to trade lower on the day. It might close lower, and I thought they would, but they did make a huge run up at the end. But I think one of the things you want to look at is what showed this and what sparked this, okay? And if you go back just a couple of weeks ago, I think you saw that the Russell was one of the first indexes to break. And again, those are all warning signs, okay? Remember, markets repeat themselves, things happen, and when your people are telling you, and when people are saying that you need to move from the risk-on trade to the risk-off trade, if anybody really knew when it was time to move, then we'd all be billionaires, because you would actually know. The reason that you get asked and told to move risk on, risk off, risk on, risk off, risk off, or whatever, is because it keeps your money in the market, it keeps your cash in the market, so it keeps the advisors making their commissions. I think that you must take very sharp look at that. If you're in good, solid companies, okay, then your best bet is to just stay in them and let the market trade, okay? Obviously, we think the best is to be hedged, all right, because we believe in the hedging model that we create. So we believe in being hedged. But barring that you don't want to hedge, barring that you don't want to get involved in that, then the best thing to do is not to try to pick what's hot and what's not, because nobody really knows. We only know that we can look at a pattern. We only know that we can look at the technicals of a stock or a commodity or whatever and make our decision from there. Nobody knows exactly when the next big move is going to come. And anybody who tells you they do know is a liar, or they've got inside information. Okay, the best way is to be hedged or to sit tight. Okay, if you've bought good companies and you're in good stocks, then you take the good with the bad. But that's one of the issues, because so many people are over leveraged and over margined. In the meantime, we're going to step out for a break here. This is Bubba's Bottom Line. Todd Bubba Horwitz will be right back with more of Bubba's Bottom Line after the break. What's up, everyone? I just want to remind you, on Saturday, October the 20th, I'm doing a hedging webinar. It's free. If you want to join me, go to bubbatrading.com and just fill out the little link, and you will be entitled to come and watch the webinar for free, okay? And of course, if you'd like to help us with our high school program, go to Patreon, patreon.com/Bubba Trading. That's patreon.com/Bubba Trading. And of course, don't forget to catch the Bubba Show every day from 4 to 5 Eastern at libertytalk.fm. Now, let's get back to Bubba's Bottom Line. Welcome back to Bubba's Bottom Line. Todd Bubba Horwitz with you. And of course, as we've been talking about, last week was pretty ugly. It didn't catch us off guard. We were not surprised at all. We had felt that the markets were looking like they were going to break, and you could start to see it from the Russell and NASDAQ, but the Dow was ugly. The S&P was ugly. The NASDAQ was really ugly. Of course, Friday they had a nice big rally, but the rally wasn't a surprise. I think one thing you always have to remember is that markets themselves they're not going to go straight down. They're not going to go straight up. So it's called, when the markets are going straight down, at some point they're going to have a dead cat bounce. What is going to happen from here would be the key. And my guess with you is I think we're going a lot lower. Okay, that's my opinion from here. However, there will be opportunities. And as we've said many times, what we were going to look for was that big rally to sell into. But I think the big important thing here to notice is the VIX futures have rallied significantly. And what's more to notice is the volatility on the individual options. Now, the spiders are trading at an implied vol of about 23%. They're implying about a $9 move this week, which is like a 4% move, which they don't ever move 4%. It takes an act of Congress to get them to move 4%. And I think that is a problem. That to me indicates there's possibly some more selling coming. I think it'd be very interesting to see the opening tonight, okay, and then into the morning, what it looks like. But it's hard to say, but if we get a big spike rally, I'd certainly look to be selling it myself. Because again, I think that you're starting to see a lot of breakage and a lot of breakdown. You've got earnings coming out They started on the weekends, but you've got Netflix this week, you've got some others this week. And I think the earnings, everybody's priced in how great these earnings are going to be. And I have no doubt they'll be probably pretty good. But the real question is how are the companies going to guide forward? What the guidance is going to be? And I can't imagine that they're going to guide forward well when they're going to have more debt and more salary. I think it's going to cut right into their profits. So I think that becomes a bigger issue here. I think when you look at what happened with oil last week, oil sold off as we thought. We were not in. We're still licking our wounds from our last beating in oil. But we did see that it did sell off. It did close the week on support. And certainly we will now look to see if the rally that comes back makes a lower high. And then we'll look to be sellers of oil once again. I think it was very interesting that we saw gold break out finally. Okay, it was in that 1180 to 1220 range. Now we had actually bought right here at 1188. And of course now we are seeing gold over 1220, actually got to 1230 on Friday. And again, if it can hold 1220, I think there's a lot more room to go on the upside. Now again, we are not believers of gold being a fear asset. We believe gold is a hard asset that everybody should have some representation of within their portfolio. It's as simple as that. I don't buy gold when I'm worried about the market. I buy gold consistently when it's at good solid levels, and I like to hold it as a good hard asset, very much as like I'm holding in my house. It's not an asset that I like to trade. It's an asset that I like to accumulate. That's just my personal views of looking at it, but it is not a fear asset. It's a hard asset, okay? So keep that in mind as we take a look into the agricultural world. Grains were higher last week. Wheat was the weakest for a change, but you had corn breaking out of that key 370 level we talked about, which now it looks like we're clear to go to 380, possibly $4. You've got soybeans very much above that 860 now. Looks like the next target of the soybeans will be 880, then $9. And of course, wheat is in this real tight range. I expect wheat to make a huge breakout, and I do expect it to be upside. I know we had a USDA report last Thursday. I still haven't looked at the report because I really don't care. But I think that based on the action, it was either oversold and it was a bearish report or it was a bullish report. My guess is it was probably bullish. But the markets did rally, and they have rallied since. My big concern was wheat that actually was higher on Thursday, sold off, but it did rally nicely on Friday. So we look for a continued rise now in the grains. Again, as we've said many, many times, we believe the trade wars have no effect here, and I think we're right. Okay, the meats had a little bit of a rough week. I think you saw the feeder cattle were the roughest, and you can probably, if you want to blame something, you might be able to blame the high price of corn. Me, it just looks like it was a blow up to the downside and creating just another buying opportunity. Fat cattle or live cattle closed right on support. We're looking to be buyers. And hogs, December hogs closed right on support. We're looking to be buyers there as well. We're very confident and very bullish the agricultural space, believing that the equities are going to sell off, and that as equities sell off, that money is going to flow into grains and livestock and other commodities. I think you saw sugar's been rallying. Cocoa's been a little bit weak, but rallied Friday. Coffee has had a nice move off the bottom. So again, there's a lot of reasons to believe that we're going higher. I think the bond markets had showed you exactly what we expected them to do. The bond futures rallied a little bit, which brought rates down a little bit. And again, remember, rates went up so fast from the last time up, you assume that there'd be a sell-off, which means that the bond futures would rally. We think that, of course, that rates are going significantly higher, and we expect to see 3.5 10-year. Actually, we're looking for 3.5 to 4% before the end of the year, which also ties into the dollar. One of the ways that the Fed is able to try to suppress rates globally is by keeping the dollar weak. Well, because of the collapsing emerging markets, they haven't been able to do such a good job there either. And of course, again, we said earlier, we should just end the Fed and let the free markets take, but then you wouldn't have all this manipulation of currency. Okay, you've got the potential meeting with Xi and Trump, and again, Xi's going to wait out to see what the midterms are going to bring. I think that the midterms are going to bring, actually, truthfully, I believe they're going to be a red wave. I think that we're going to maintain, and I shouldn't say we're because I'm a libertarian, and I don't really like either the left or the right, but I do think that the Republicans are going to maintain control of both the House and the Senate. Okay, So hopefully we can get some more things done. But I think that's what everybody's trying to wait to see. Anybody who's got a bicker with Trump, like Xi from China, they're waiting to see what happens here. And if he loses some of his power, they may sit tight and really go after him. So we'll see how that plays out. And again, I don't think that's going to be the case. And I think that Trump is doing a good job here. The trade wars do not worry me whatsoever. And I think that, again, the markets have told you pretty much they're not about it either, but everybody wants to make them the story. Okay. And of course, now you've got the fear mongers out charging. Okay. And I can't say names, but there's a couple out there that I caught on air that have been bearish since 2010. But one said, we said to buy when Trump got elected. You can see, we can prove it. We're buyers. In the meantime, all their paperwork was bearish. Okay. So as they got it stuck to them the entire way up in the market, okay, they said they were buyers. Well, again, this is one thing I always warn you of, okay, is don't fall for the fear trade or the fear trap. It's the biggest crux in the world. Make sure that whatever you do, you understand what you're doing with your money in your portfolio and understanding what is going to happen next, okay? Again, whether you're using an advisor, whether you're doing it yourself, before you make a dramatic decision to do anything, I urge you to take a deep breath, relax, look at it, and make sure that you agree. So that means that you should understand what your portfolio is doing either way, whether you're controlling it yourself or you're having somebody else. I have no problem. I use an advisor for part of my stuff as well. So again, but you should have an understanding and make sure that whatever they're doing, you understand what they're doing, because otherwise you're going to end up just like the other sheep that are get clobbered once again as we start to see these markets fall apart. And again, this time is not different. It will end the same way. And 20 years from now, whatever period of time, it will be higher than it is today. But there will be some demons here, and there should be some problems. So we'll see what happens. In the meantime, we're going to step out here for a break on Bubba's Bottom Line, and we'll come back with my commentary after the break. This is Bubba's Bottom Line. Todd Bubba Horwitz will be right back. So everybody, I want to remind you, on Saturday, October 20th, I will be doing a webinar on hedging. I'd like to invite you. It is free. There is no charge. All you have to do is go to bubbatrading.com, fill out the little box, the link, and you'll be sent an invitation. And also, you want to help us with our high school program, Patreon, patreon.com/Bubba Trading. That's patreon.com/Bubba Trading. And of course, don't forget to catch the Bubba Show every day from 4 to 5 Eastern at libertytalk.fm. Now let's get back to my commentary and football picks on Bubba's Bottom Line. Let's get back to the show. Welcome back to Bubba's Bottom Line. Todd Bubba Horwitz. And of course, each and every week I give you my take and my commentary. And, you know, I've been trading for 39 years. And I've heard every story of why markets do what they do. I've heard every single thing that has happened. And I can tell you one thing, that nothing bothers me and irritates me more is when the pundits and the advisors can start to whine about the speedy boys, the speedy traders, the algorithm traders. You know, nothing has changed. I've been on the floor since 1980. Nothing has changed since 1980. You know, you want to talk about, they get hyped up about a big move of 500 points or 1,000 points. Do you realize, okay, that we're at a 26,000 point index? 100 points is virtually hardly worth talking about, okay? It's no different than when you had a 10 point or a 20 point move on a $2,000 index. Again, we want to make this into the story. So what is the blame? Oh, well, it's the speedy boys. It's the algorithms. They're crashing the what do they call it? The flash crash. And I say, BS, it's a crock, okay? Without the speedy boys, we wouldn't be paying under $5 commissions, okay? We wouldn't be paying the low rates of commissions we were paying. We wouldn't have the tight liquidity that you have in the markets, okay? When there was big moves, when you had real market makers like me in the pits, you don't think that we pushed the markets around as well? You don't think that we walked away and when the sellers were coming, you think that the market makers stood there, okay, and let somebody keep bearing into them? No, they kept lowering the price, okay? So we had this same kind of movement. Is it a little bit faster today? Yes, but why is it faster today? Okay, think about it. Because before, back in the 80s, let's say, the 90s, you had to call your broker. He had to call his broker on the floor and execute your order and then go to the market maker. Now you can have, not the speedy boys, you can have everybody like yourself, me, all at one time saying, I think it's time to sell. Boom, you hit the button so everybody sells at the same time. It has nothing to do with the algorithm trading. It has the same thing to do with what it always had to do with, which is the human emotion of traders. Okay, the emotion of investors. The difference between then and now is we didn't have the information so fast. You had to wait to hear it on the radio. You didn't have it on your phone in 5 minutes where you could actually trade from your phone. So take the BS and the pundits telling you about the Flash Boys and the author of the book, The Flash Boys, giving you all the reasons why they're no good. The Flash Boys, the speedy traders, have done nothing but benefit the small individual independent trader because it gives them a chance to trade inexpensively, gives them a chance to get in and out of the markets. It creates liquidity. It does not create any more trouble in a market than when we had sell-offs before. Okay, in 1987, when some guys were selling puts in the market that were pricing below zero in the price of the market, you tell me about those the flash crashes and all the BS. Okay, it's a crock, and anybody who wants to tell you differently and blame it on the flash crash is the same people that want to blame everything, that can't stand up and say that right now the markets are probably in a little bit of trouble. So let's not look to put blame except on the Federal Reserve that's allowed to create this debt, and the government that keeps printing money and tries to continue to add more debt instead of trying to balance the budget. That's it for Bubba's Bottom Line. I am Todd Bubba Horwitz, and of course I got to give you my football picks, right? I like 2 games today. Jacksonville over the Cowboy, okay? But our best bet of the week is the New England Patriots over the Kansas City Chiefs. This is Bubba's Bottom Line, Todd Bubba Horwitz. Have a great weekend, everybody. Thanks so much. We'll see you tomorrow with Bubba's Daily Update and next weekend with Bubba's Bottom Line. Thank you all. We'll see you later.